We are doing a report on Barclays Bank credit risk done by Stephen James and Sunny Kansina of Section D.
Overview of Barclays Bank credit risk exposures. Credit risk is the risk of suffering financial loss if the consumers, clients, or bank counterparties fail to fulfill their contractual obligation to the bank. The credit risk is that the bank faces mainly from wholesaler and retail loans and advances, together with the counterparty credit risk arising from derivative contracts entered into with clients. Other sources of credit risk arises from trading activity, including debt security, settlement, balances with market counterparties available for sale of assets and reverse purchase agreement. Losses arising from assets held for trading, that includes derivatives and debt securities, are accounted as trading losses rather than impairment charges, even though the fall in value causing the loss may be attributable to credit deterioration.
Now talking about the balance sheet of the bank as on 31st December 2010. This is divided into two parts, on balance sheet and off balance sheet. On balance sheet consists of cash and balance at central banks, trading portfolio asset, financial asset, derivative and financial instruments, loan and advances. And on balance sheet total assets amounts to $643,035 million. Off balance sheet consists of securities, guarantees and letter of credits, acceptance and endorsement, documentary credits, standby facilities, credit lines and other things. And off balance sheet amounts to 169,037 million pounds. As on 31st December 2011, credit risk was broadly flat at 805,958 million pounds. Of the remaining exposure left unmitigated, a significant portion related to cash held at central bank available for sale of debt securities issued by government, cash collateral and settlement balance, all of which are considered as low risk. Talking about netting and set off, the group has the ability to offset its assets and liabilities position on default or bankruptcy of the borrower. So in case the borrower default, the bank can overcome this risk. Talking about the collateral securities, the bank has the home loans, wholesale lending, credit card, lease asset, etc. Even like derivative, reserve repurchase agreement, financial guarantees and similar off balance sheet commitments. Now risk transfer is the group in some cases holds guarantees, letters of credit and similar instruments from third parties which enable it to claim settlement from them in the event of default on the part of the counterparty.
Principles for the assessment of banks' management of credit risk. First is establishing an appropriate credit risk environment. The board of directors should have responsibility for approving and periodically reviewing the credit risk strategy and significant credit risk policies of the bank. Banks should identify and manage credit risk inherent in all products and activities. Second is operating under a sound credit granting process. Banks must operate under sound, well-defined credit granting criteria. Banks should have a clearly established process in place for approving new credit as well as the extension of existing credits. All the extensions of credit must be made on an arm's length basis. Third one is maintaining an appropriate credit administration, measurement and monitoring process. Banks should have in place a system for ongoing administration of their various credit risk-bearing portfolios. Bank must have in place a system for monitoring the condition of individual credit including determining the adequacy of provisions and reserves. The bank should also develop and utilize internal risk rating system in managing credit risk. Next is ensuring adequate control over credit risk. Banks must have a system in place for maintaining problem credit and various other workout situations. Banks should also establish a system of independent ongoing credit review, and the results of such review should be communicated directly to the board of directors and senior management. Finally, the role of supervisors. Supervisors should require that banks have an effective system in place to identify, measure, monitor, and control credit risk as part of an overall approach to risk management. Thank you.